I'm sure you've heard this by now, but the Federal Reserve raised the interest rate by 0.75%, 75 basis points the other day, which is the largest rate hike in nearly 30 years, since 1994. So in this video, I want to talk about what all of that means and how this relates to mortgages. So first, what is the Fed? The Fed is the short form of Federal Reserve System, which is the US's central banking system, which was created in 1913 with the Federal Reserve Act. And its job is to alleviate financial panic. So it does that by regulating the national banking system, managing inflation, and stabilizing financial markets. And the board members are appointed by the president, but don't worry, they are all neutral. Their job is only to stabilize the economy. And one of the ways that they stabilize the economy is by regulating the interest rate. So the federal interest rate is the rate at which one bank lends money to another bank. By law, banks must have a certain amount of reserve cash on hand in their vault at the end of each day. And that is so that if a lot of people want to suddenly withdraw a lot of money, the bank has enough cash on hand so as to give that money to its customers and the bank doesn't become insolvent. So if one bank lends out a lot of money one day and at the end of that day they don't have the cash on hand that they're required to have, what they can do is borrow money from another bank and then pay that money back to that bank the next day with interest. And the Fed determines what that interest rate is. And that interest rate affects all kinds of loans like credit card loans, car loans, mortgages, and other loans. Now the interest rate is usually a target range. In essence, the Fed is saying, here is the rate at which we suggest you should lend money to each other. Something between, say, 1.5% to 1.75%. Now, on March 26th, 2020, the Fed reduced the interest rate down to, wait for it, 0. And they also reduced the required reserve to 0 as well. So what that did is it allowed banks to lend out a lot of cash because banks now no longer had a required amount of reserves that they needed to hold in their vaults, and they didn't have to pay back money that they were borrowing from other banks with added interest. And that put a lot of money into the economy. Car loans were cheaper, so people bought cars. Credit card payments were lower, so people spent more money. Mortgages were lower, so people bought houses. And the economy really boomed because of this. Just look at your stock portfolio from the past couple years and you'll see that it really went up. And the reason the Fed dropped the interest rate down to 0 is because everybody was sitting at home afraid of COVID, not working, and a weak economy in the midst of a global pandemic is a recipe for disaster, and the Fed did not want that. And now the federal interest rate comes back into play. Since the beginning of this year, the Fed has begun to raise the interest rate back up from 0. So why is the Fed even raising the interest rate if the economy has been doing so well? Good question, glad you asked. Now before I move on and talk about why the Fed is raising the interest rate, do me a favor and hit that like button. That lets YouTube and myself know that people are liking this content, and hopefully this video can get out to more people like you. Inflation is the key word that we've been hearing over and over and over again. I just went to the gas station 2 days ago, put 60 bucks into my Subaru, and it didn't fill up the tank. And listen to what I said on this channel 2 years ago. The good thing is gas is pretty cheap right now. My $22 fill up is enough for the week. The Fed likes to keep inflation at about 2%. But in May, just last month, the CPI, the Consumer Price Index, came in at 8.6%. Now, when you have high inflation, money is devalued. That's because too much of anything makes it less valuable. Just think of how iron compares to gold, for example. There's more iron than there is gold, so therefore iron is less valuable than gold. And the same thing is true with money. Too much of it floating around in the economy makes it less valuable and you have less buying power. So that's where the government steps in. They want to reduce inflation, which means reducing the amount of money floating around in the economy. And to do that, they need to reduce spending. And the way they do that is by raising the interest rate. Let's say, for the sake of example, your credit card went up from 15% interest to 65% overnight. I think you would probably use your credit card a lot less. So the ultimate goal in raising interest rates is to slow down the economy so there's less money in it, and that will help our money to be devalued less quickly. And this will also help us catch up with supply. Over the past couple of years, we've heard a lot about supply chain issues because of the war in Ukraine, because of COVID lockdowns. So less buying will help increase supply, which is what we desperately need. So hopefully it's clear by now why mortgage rates have been going up since the beginning of this year. The Fed has raised the interest rate at which banks borrow money from one another. And because it costs them more money to borrow money, they pass that cost on to you, the consumer, when they loan money out to you. 1 year ago, the average rate for a 30-year fixed mortgage was 2.96%. Last week, it was 5.23%. And today, June 17th, it is 6.05%. Since the beginning of the year, mortgage rates have gone up about 3%. We were at about 3.41% on January 3rd. So what's going to happen moving forward? I don't think that the 75 basis point increase that we saw the other day is the last rate hike that we're going to see this year. The Federal Reserve Board has 4 more meetings scheduled for this year, and Jerome Powell, the chairman of the board, said that they anticipate 4 more rate hikes throughout the rest of this year. Listen to what he said the other day.
And anticipates that ongoing increases in that rate will be appropriate.
The good news, though, is that they are expecting inflation to be significantly lower in 2023. But then again, none of us knows for sure. Back in March, they increased their projection for the end of the year by 1.5%. In other words, they were expecting rates to be at about 2% by the end of the year. Now they're calling for 3.5 or perhaps even more by the end of this year. So the truth is, nobody can time the market. You just never know what tomorrow will bring. So that's why I say that the best time to buy a house is when you need one and you can afford one, because time in the market always beats timing the market. So hopefully that's clarified a bit what has been happening at the federal level. My guess, though, is you're probably curious as to how that has affected the local market here in Boise. Well, you're in luck. I just did a full market update on that. What are prices doing? What's the inventory like? Click on that video right here. And as you do that, don't forget to subscribe so we don't lose touch with each other.